Imagine you've invested in a company. You're hoping your wealth will grow, right? But how does that actually happen? Is it all just about the share price, shooting up, or is there maybe another piece to that puzzle, something a bit more tangible, maybe even lands directly in your bank account? Welcome to the deep dive. Today, we are plunging into the fascinating and sometimes, fiercely debated world of dividends. What exactly are they? Why do they stir up so much discussion in finance? And, how do companies even decide whether to pay them out or just hold on to their cash? Our mission today is to unpack the core theories behind dividend payments. We want to explore why those elegant theories often clash with the messy realities of the business world and understand the various ways companies actually choose to distribute earnings.
Yeah, and we've really gone deep into a comprehensive source on dividend theory for this one. It lays out pretty much everything, from the foundational economic models right down to the nitty-gritty of practical considerations and actual real-world policy choices. It's quite a journey, really, from the, let's say, abstract whiteboard to the bustling stock market floor.
Okay, let's unpack this then.
Okay.
When you own a piece of a company, our sources make it pretty clear there are fundamentally two main ways shareholders gain wealth. Through those direct cash payments, the dividends, and through the share price itself going up, appreciation. I like thinking of it like a fruit tree. You can either eat the fruit it produces each season, those are your dividends, or you can just watch the tree itself grow bigger and more valuable over time. That's your share price going up.
Exactly. That's a great analogy. And this brings us right to the core dilemma for any profitable company. What do they do with their hard-earned money? Do they pay out a chunk of those earnings directly to investors as dividends, give them that immediate cash return? Or do they keep it, reinvest that money back into the business, hoping, of course, to fuel future growth and, boost the share price down the line? It's this constant balancing act for every single board.
So if that's the core dilemma, how do they even begin to decide? Where do you start? That's where the theories come in, I guess.
Yeah.
Our deep dive into the material showed three main theories that really shape how we understand dividend payments.
That's right. We'll be looking at the dividend valuation model, then the Gordon growth model, and maybe the most thought-provoking one, Modigliani and Miller's dividend irrelevancy theory. These models sort of provide the theoretical bedrock. They show us what should happen, in a perfect world.
Okay, let's start with the dividend valuation model. The core idea here, basically, is that a company's value is really about the dividends it's expected to pay out in the future, how fast those dividends grow, and importantly, what return investors like us actually demand for holding that stock. The classic way to calculate it, as our source shows, is P0 equals D0 times 1 plus G, all divided by RE minus G.
Right. So to quickly break that down just for the ear, P0, that's today's share price, the current one. D0 is the dividend that was just paid. D1 would be the dividend you expect, say, a year from now. RE is the cost of equity, basically, the rate of return investors need to justify holding that particular share given its risk. And G, that's the future annual dividend growth rate. And a really crucial point here is that G is always an estimate. It's a projection. It's not a guarantee. Often it's based on, historical trends. But if a company suddenly changes its dividend policy, that G can shift dramatically.
Yeah, that makes sense. And that G, that growth rate, leads us perfectly to the Gordon growth model. This one really digs deeper into the cause of that dividend growth, right? Mm-hmm. His model suggests that, generally speaking, unless a company has some massive unexpected breakthrough or maybe suffers a major misfortune, then growth mostly comes from just doing more of the same thing, just on a bigger scale. Mm-hmm. Like you said, expanding from 4 factories to 5 by reinvesting the earnings.
And that's precisely the link. Apart from, raising outside capital, that expansion only happens if some earnings are kept, retained within the company. Think about it. If a company paid out all its earnings as dividends, it would have no extra capital to invest, couldn't buy more assets, couldn't make higher profits or grow future dividends. It's like that farmer eating all their seeds. There's just nothing left to plant for the next season.
So the Gordon growth model even gives us a simple formula for this growth. G equals BR, where B is the proportion of earnings kept back, retained.
Mm-hmm.
And R is the rate of profit earned on any new investment made with that retained cash.
Exactly. So if B is high, you retain more earnings, which means more investment, hopefully higher profits, and ultimately higher future dividends.
Right. And you can actually plug that growth formula right back into the share price calculation.
You can, yes. So P0 equals E1, that's expected earnings next year, times 1 minus B, all divided by RE minus BR. Now, when you first look at that formula, it kind of seems to suggest that if you just change B, the proportion of earnings you keep, the share price must change.
Yeah.
But this is exactly where Modigliani and Miller walk in and famously say, hold on a second, not so fast.
Okay, so this is where it gets really interesting. Modigliani and Miller's dividend irrelevancy theory. I mean, that sounds like a huge claim. The dividend patterns in a perfect market have absolutely no effect on share values.
How can that
Possibly be. It feels totally counterintuitive to everything I thought about getting paid out.
It absolutely is counterintuitive, and that's why it was and still is so powerful. Their broad suggestion basically is this. If a dividend is cut now, the extra money kept back, the retained earnings, if they're reinvested properly, should lead to higher future earnings and therefore higher future dividends. The lower dividends you get today are, in theory, precisely offset by the increased present value of those bigger future dividends.
So it's like, it almost doesn't matter when I get the cash as long as the total value I get over the long run is the same. But our sources were really clear, weren't they?
Yeah.
There's a crucial condition for this perfect balance to hold.
Yes, absolutely crucial. This perfect equilibrium only works if the retained amounts are reinvested at a rate equal to the cost of equity. So R equals R. Let's maybe walk through a couple of quick examples from our source to really illustrate this aha moment. Okay, imagine a company. It earns $0.80 per share. And the required rate of return investors demand, the cost of equity R, is 20%.
Okay, got it. So example 1. If this company pays out all its earnings as dividends every year, forever, the share price would be $4. Okay, that makes sense. It's just the present value of getting that 80 cents forever, discounted 20%. Simple perpetuity.
Exactly. Now, example 2. What if, starting next year, the company decides to change policy? They'll pay out only half its earnings as dividends and retain the other half. And critically, let's assume the rate of profit they earn on that new investment, R, is exactly equal to the cost of equity. Both are 20%. Now, when you plug those numbers into the model, guess what the share price calculates to?
Based on the theory name, still $4.
Still $4, exactly.
Wow. So the share price doesn't budge an inch. They're keeping half the earnings, cutting my current dividend in half, but the share value is exactly the same. That's the core of their theory, isn't it? The dividends are irrelevant in this specific ideal scenario.
Precisely. Now let's make it interesting. Example 3. What if the company has, say, a technological breakthrough? It can now invest those retained earnings at a higher rate of return. Let's say your aim is still 20%, but the return on new investment, R, jumps to 30%. This is genuinely good news, good fortune for the company.
Okay, and intuition says that good fortune must increase the share price. So what happens?
It does. Our source shows that in this scenario, the share price actually doubles to $8.
Wow. Okay, so that's the real power of smart reinvestment. It can potentially far outweigh just getting a small dividend today.
Absolutely. And then let's look at the flip side. Example 4. What if the company invests those retained earnings poorly? Let's say R is still 20%, but R drops to just 10%. This is either, bad luck or maybe just poor management decision.
And in this case, that original $4 share price takes a hit, doesn't it? It drops significantly, down to about $2.67 according to the source. So making bad investment decisions with retained earnings directly hurts shareholder value. No surprise there, really.
Right. So what's the powerful takeaway from Modigliani and Miller here? Well, if a company retains earnings just to do more of the same, meaning it reinvests that money at a rate equal to what investors already expect, the share price shouldn't be affected. It's basically a wash.
Okay. But if a company retains earnings because it has opportunities for higher returns, maybe expanding into a new market, becoming more efficient, then cutting dividends actually increases shareholder value, theoretically, which raises a really important question. Why would shareholders ever complain about a dividend cut if it's actually making them wealthier in the long run?
Exactly. And conversely, if a company retains earnings but can only generate lower returns than investors demand, maybe it's just sitting on excess cash in a bank account earning next to nothing, then dividends should actually be increased. The company should give the money back to avoid the share price falling. If there's no good use for the money internally, the best thing to do is return it to the shareholders. Let them invest it elsewhere. This is Modigliani and Miller's ideal scenario. It's almost like a perfect economic laboratory, isn't it? Where all information is known, everyone's rational.
Which, of course, brings us crashing back down to the real world.
Yeah.
We've laid out these beautiful logical theories. On the whiteboard, it all makes perfect sense. Smooth, elegant. But then you walk onto the trading floor or you talk to a real CEO, and suddenly it feels like those perfect models just hit a brick wall, don't they?
They really do.
Because, as our sources point out again and again, theoretical outcomes don't always line up with practical considerations. Why?
Well, the theories make simplifying assumptions, right? Perfect markets, no transaction costs, everyone knows everything instantly.
Yeah, none of which actually exist outside the textbook.
Yeah.
So what does this all mean for the real world? It really seems like human behavior and, market realities just throw a huge wrench into those elegant theories.
They absolutely do. A massive practical issue is signaling. Think about it. A dividend announcement is public information. Any change in that dividend sends a signal. But what signal? Does a dividend cut mean the company's bracing for hard times? Or does it mean they found a fantastic high-return investment opportunity and need the cash? There's what we call information asymmetry. Directors usually know more than the public. And shareholders, well, they're almost always unsettled by abrupt changes, even if the change is theoretically for the better.
That makes perfect sense. Yeah, a sudden cut can cause a lot of panic, a lot of uncertainty, even if it's actually the strategically right move long term. And tied right into that is the whole issue of trust, or lack thereof, in directors' forecasts. Directors might be totally transparent, lay out their grand plans for reinvestment, explain why they're cutting the dividend, but if investors just don't share their optimism about the company's future, well, the share price is going to be affected regardless of the stated policy. It really boils down to investor confidence, not just the numbers on a spreadsheet.
Another really common practical argument you hear is the bird in the hand idea. This basically says investors prefer a definite current cash dividend, a bird in the hand, over some uncertain future promise of potentially higher value. Because, anything could happen down the line. Risks, uncertainties.
That sounds pretty reasonable to me. Cash now versus maybe more cash later.
It's a very persuasive argument for many individual investors, definitely. But theoretically, our source highlights that it's often considered, incorrect from a pure finance perspective. Market forces should mean a share price is already correctly set for its level of risk and expected return. And from a diversified investor's viewpoint, the capital asset pricing model CAPM, which helps figure out expected return for risk, suggests that extra risk is correctly compensated by extra potential returns. So they should be largely indifferent. If more cash is paid out as a dividend, the investor can simply choose how to reinvest it or spend it themselves. The choice is theirs.
Okay. That's a tough one for many people to accept, I think, preferring that cash now. Then there's something called the clientele effect. What's that about?
Right. The clientele effect suggests that different groups of investors, different clienteles have different needs and preferences. Think of a pension fund, for example. They often need regular, predictable income to pay out pensions, so they'll naturally gravitate towards and invest heavily in shares that provide exactly that kind of steady dividend stream.
Okay, makes sense.
So if a company they've invested in suddenly changes its dividend policy, maybe cuts it drastically or eliminates it, it really messes up these carefully constructed portfolios. It forces those investors to adjust, maybe sell the shares, buy something else, incurring transaction costs, maybe even triggering tax issues. They built their strategy around that dividend.
So it disrupts their whole plan.
Yeah.
And beyond investor feelings and strategies, there are just very real, tangible constraints, right?
Absolutely. Company liquidity is just paramount. Forget theory for a second. Regardless of what might be best for shareholder value on paper, a company must stay liquid. It has to have enough cash to operate. They might be forced to cut dividends simply to stay solvent, to pay the bills. You just can't pay out cash you don't have.
Yeah, reality bites. And related to that, you mentioned borrowing covenants.
Yes. When companies borrow money, especially large amounts, the lenders, banks, bondholders often put clauses in the loan agreements. These covenants can limit dividend payments, maybe restricting them to a certain percentage of earnings or something similar. It's a way for the lenders to protect their own investment, basically ensuring the company keeps enough cash available to repay its debts first.
Okay, another practical hurdle. And then there's just basic legal constraints too.
Yep, very straightforward. In most places, companies can only pay dividends out of distributable reserves, essentially, enough accumulated profits that are legally available for distribution. If a company doesn't have those reserves, it simply cannot pay dividends. Full stop. Legally impossible.
Wow, okay. Lots of real-world roadblocks.
Yeah.
Our deep dive also brought up a pretty clever practical alternative, though. Scrip dividends. What are those?
Yes, scrip dividends. Instead of paying cash, a company offers shareholders the choice to receive new shares instead.
Shares instead of cash.
Right.
Why would you do that?
Well, it can be super beneficial. For investors who don't actually need the cash right away, they get more shares without paying any brokerage fees or transaction costs. It just automatically increases their holding. And for the company, It's great because it conserves cash, boosts their liquidity, strengthens the balance sheet effectively. Plus, depending on the country, there can sometimes be tax advantages for one or both parties. It can be a real win-win in many situations.
Interesting. A way to keep everyone happy, potentially.
Potentially, yes. So, given all these complexities, the theories, the signals, the trust issues, liquidity, legal stuff, it's really no surprise that companies adopt quite different dividend payment policies, trying to find a balance that fits their unique situation and goals.
Right. Let's run through some of those policies. First up, just constant dividends, paying the same amount each time.
Yeah, the big pro there is clear predictability. Shareholders know exactly what they're getting, which is nice.
But the downside?
The con is that shareholders might get pretty dissatisfied if the company's earnings are clearly rising, maybe year after year, but their dividend stays flat. They might start questioning, what are you doing with all that extra profit? Why aren't my payouts growing if the company's doing so well? It raises questions about investment quality.
Okay. Then there's the constant growth policy. Sounds appealing.
Very appealing, yes. Also predictable, promising that steady increase year after year. Investors love that. The challenge, though, is that the dividend growth rate might not always match the earnings growth rate. Things fluctuate. So what happens if the company hits a rough patch and can't actually sustain that promised growth rate? It can lead to disappointment.
Right. How about a constant payout ratio, like always paying out, say, 25% or 50% of whatever the earnings are?
This one has a very clear, logical link between the dividends and the company's performance, the earnings.
It's straightforward.
It is, but the tricky part is, again, the signals it can send and how they might be misinterpreted. For instance, if earnings fall, and because of the fixed ratio, dividends are automatically cut, shareholders might see that as a bad sign, confirmation that earnings are poor and likely won't improve quickly. But interestingly, if earnings fall and the directors decide to override the policy and maintain the dividend anyway, that's often interpreted very differently. It's seen as a strong signal that management believes the earnings dip is just temporary and they're confident about the future. So the deviation sends a signal too.
It's all about reading the tea leaves, isn't it? What about treating dividends as residuals? That sounds quite theoretical.
It ties right back to that Modigliani and Miller logic we discussed. The idea here is that the company's first priority should be to invest its earnings in any available opportunities that promise a return greater than or equal to the cost of equity, R, or RE, because those are the investments that either increase or at least maintain shareholder value.
Okay, invest wisely first.
Exactly. Only after all those valuable investment opportunities have been taken, only when they run out, should the company then pay dividends from whatever earnings are left over the residual amount. The thinking is, if the company has no more great internal uses for the cash, give it back to the shareholders. Let them take that cash and invest it themselves, perhaps in a different company that does have high growth opportunities.
That makes a lot of sense from a pure value perspective.
Yeah.
And now finally, there's the really bold policy. No dividend at all.
Yep. Famous examples, tech giants like Microsoft, Apple, both went many, many years without paying a single dividend in their high growth phases.
And what happened? Did shareholders flee?
Not at all. Their share values still rose dramatically. Why? Because they were just immensely successful companies, reinvesting everything into phenomenal growth, and investors valued them based on that huge earnings potential.
So you don't need dividends for share price growth if the company is performing exceptionally well.
Apparently not. Though this no dividend policy does make that original dividend valuation model quite difficult to actually use. You have to make some very contentious, some might say wild assumptions about what future dividends might look like if they ever decide to start paying them decades down the line.
Right.
But yeah, if we connect this back to the bigger picture, these different policies really just show how companies try to navigate all those trade-offs we talked about. Balancing investor satisfaction, financial health, funding growth, all while trying to project confidence in their future prospects.
It's definitely clear that dividends and dividend policy, well, they're always going to be a subject of debate and discussion. There's no single easy answer. Theoretically, the position seems quite clear, doesn't it? If a company cuts dividends and those retained earnings are wisely reinvested, getting a return at or above what investors require, then shareholder wealth should actually increase.
That's the theory, yes. However, back in the real world, it's far more complicated. Investors aren't always perfectly rational robots. There are real transaction costs if they have to change investments. Market imperfections are absolutely everywhere. Information isn't perfect. All of these factors just make determining a truly successful and popular dividend policy one that genuinely aligns with maximizing shareholder value while also managing expectations and signals. Well, it makes it rather more difficult than the elegant theories might suggest.
Absolutely. It's a fascinating mix. Finance theory and human psychology, really. So maybe here's a final thought for you to ponder. When you next look at a company's stock, go beyond just the share price or the current dividend yield figure. Take a moment to really consider what that company's dividend policy, whether it pays a lot, a little, or nothing at all, and whether it's steady or changing, what might that policy be signaling about its view of future investment opportunities? And what does it signal about management's confidence? What does that deeper story tell you about the company's real potential to generate long-term wealth for you as an investor? It's a whole new layer of insight, isn't it, once you start peeling back that theoretical curtain.